Lighting. Really?
Yeah.
Is it a little tilted?
Hey everybody, we are live again here with CPA David Kupferman.
Hi.
Thanks for being here.
Nice to meet you,
We're
Brad.
actually here at his offices here in the North Beach. It's a bit of a rainy day today, but our spirits are still high, so we'll have fun.
That's right. Well, especially since we're not only really in North Beach, we're on the edge of the Barbary Coast with a very happy and crazy history, so it's a good place to be.
It actually is, yeah. Also on the border of Chinatown, too.
We got everything
My
here.
neck of the woods growing up. Well, I'm super excited to have David here as a guest today, not only because of his knowledge of all things tax, which we're going to cover today, but also David has a wealth of knowledge and experience on the business side as well. Former CFO, former COO, and many, many years consulting and advising high-growth companies. So I think David's a very special guest to have for all those reasons. Quick background on David, then I'll give him a chance to give his own background. David started his practice in 1994 and specializes in strategic accounting and tax advice for businesses and individuals. Your clients cover a host of industries, a host of types of owners, from real estate operators, law firms, technology companies, art galleries, software developers, and so on. So again, David has a lot of experience across a very wide range of things. I can go on and on, but definitely want to turn over to David, welcome him to the show, and give him a chance to give a background on yourself.
Sure. Okay. Well, hi everybody. So I again am David Kupferman, CPA, and I've had my own practice for for quite a while, so long I can't remember. And I originally started at one of the large global CPA firms called KPMG. Before that, originally my training was in linguistics. I speak a bunch of languages.
How many?
Around about 7. If I've had a few drinks, maybe a few more, depending. But you can't make money doing that, so I originally went to KPMG to go into international tax, and then we had kids, and it was just too much. And then I left and was CFO of a number of venture capital-backed companies, and so I really dug in and got used to how that works, and a lot of interesting educational learning experiences. My hair went gray, because at one of the ventures, my partner would cook up these. He was really great at raising venture capital to a degree, but then he was great at cooking up these crazy ideas, and he'd say, "David, you go ahead and execute." So one of the things I'd have to execute on would be, he said, you deal with technology. So we actually had Cisco routers before there even was such a thing, and I'd have to be helping to manage and architect that. I'm not a programmer, but just to make it all work. Where we had some of the original Macs acting as though they were Cisco routers. Pretty interesting stuff using Unix. So I go way back. Actually, so I stepped out of that environment because doing M&A deals was just too much. So I started my own practice, and then I really got into, because I had that background in tech, and also my connection was to the second employee of Intuit. So I go way back with Intuit. Intuit makes TurboTax, QuickBooks, and all that. So I've been kind of a techie-oriented CPA, but I've been very deep into the QuickBooks environment. And so that's a little bit about my background historically. But unlike most CPAs who are in public practice, I have been there in the trenches and started businesses, helped them get funding. I've written business models, been at the negotiating tables. I've killed companies off, shut them down, started them, the whole 9 yards. It's kind of fun. A lot of my clients, our clients, are inventors. They're creating new technologies. I sometimes say new forms of life, also in the biotech sciences. The first website ever sold, they were our client.
Wow.
Yeah, so it's been kind of interesting to see the progression of technology right here in San Francisco. During the first .com era, and before then, it was very interesting to see that it was mostly here. I remember I was working on some of the first promoting to get funding for one of the first online e-learning, corporate e-learning systems. We were trying to get it into B of A, but they really didn't get that concept of doing it in a networked environment. It was pretty interesting. And so there's that. And then in my practice now, I've kind of moved it so it's not all tech clients and tech business strategy, because over the years there's been a number of cyclical problems in the industry. There tend to be hiccups, but early on it was mostly U.S. focused, some Canadians, some Israelis, when I went to a lot of the earlier tech events. But now, San Francisco especially, it is amazing globally. There was a giant effort, and I was doing outsourcing even in India. We all thought when Thomas Friedman wrote the book, The World is Flat, that, oh my God, it's all going to go to India. And there was a lot of outsourcing there, but then people have really come to see that while you can have the monkey work, the programming being done offshore, the conception and the creativity work, and then the venture element really, really works well here. We just have a unique formula here in San Francisco, Silicon Valley. It's been very interesting to see how now San Francisco is so global, and San Francisco is like an island, and that's why prices are kind of going up high.
Yeah. And we'll tie it back to real estate later on too. But before we go any further, let me just remind the audience, for people watching live and for people watching later on too, just feel free to drop your questions into the comments, and we'll get to those as they come about too. I actually got some questions yesterday, so we'll add those into the mix. Sure. So a couple topics for David today. First topic, we're going to talk about tax deductions, and this first one is for homeowners. I'm sure you deal with this multiple times per day. But for a lot of the audience out there who is either considering buying their first home or has their first home, people hear about some of the tax benefits that come along with being an owner. Can you just speak to those and talk about them from your perspective?
Well, sure. Well, certainly you get to, if you buy a home, and let's say it's a full year, you'll get a full year's interest deduction on the mortgage interest. Now, mortgage interest is limited, however, to about the first $1.1 million of debt on your home. So if you're living in Peoria, Illinois, or Houston, Texas, generally, your mortgage is not going to be over that. But Uncle Sam limits how much interest you can deduct. So let's just say for simplicity's sake, the limitation for mortgage interest is $1 million, but your mortgage is really $2 million. And let's say that your interest is $100,000. Because you're twice over what the limit is, you could only deduct half of what the bank is going to send back to you. The bank would say that you paid, on a Form 1098 it's called, you paid $100,000, but because the limit is $1 million, you could only deduct half of that, $50,000, okay? So it is a problem for those taxpayers, those people who live in New York, Boston, San Francisco, where homes are just so crazy expensive. So yes, you can get the mortgage interest deduction, but be aware it's not unlimited.
Gotcha. And a question I got from someone yesterday was about, I know in 08, 09, 2010, first-time homebuyer credits.
Yeah.
Is that still a consideration today, or
no,
do you get that question at all anymore?
No.
Got it. Okay, very good.
I mean, there's some credits you can take. You can take money out of an IRA for like a small amount of money, which is kind of significant to a degree if you're in Peoria, Illinois. Here it's chump change.
Yeah.
No, it's not going to really. There's some minor things, but it's almost insignificant.
So the mortgage interest deduction is the biggest one. There's some other ones too.
Yeah. Then you get points. You can deduct those. You get real estate taxes, things like that. However, some of those. While you can deduct them like real estate taxes, income taxes, things like that, you can deduct them. However, then there is another way that Uncle Sam can severely crimp or limit or eliminate the deduction of those, and that's through something called the alternative minimum tax. Okay, so if you deduct a whole bunch of state taxes, income taxes, and property taxes, then Uncle Sam says through this alternative taxation system, not to get too complicated, which is called AMT or alternative minimum tax, they wipe out any of the benefits. So you really need to look at, there's a lot of complex set of variables to see if you'll be subject to it. Now, our new president-elect Trump, one of the things they've been saying they want to do is to eliminate the alternative minimum tax. That would be good for those of us who pay high mortgage interest and high property taxes in Washington State, in California, in New York. But all of those people didn't vote for Donald Trump. So that is an argument, on the one hand, that they might not eliminate the AMT. Because AMT really, pardon my French, screws over people who pay, principally it really kicks in when you have ISO stock, and it kicks in when you have property taxes. Those are some of the two principal ones. And so why would Donald Trump do that? Because it's going to be helping the people that didn't vote for him.
Yeah.
But nonetheless, the Republicans are talking about getting rid of AMT. If they do that, however, it's probably going to remove about at least 30% of the overall taxes that the government, income taxes that the government gets. So talking is one thing, but through the AMT system, our government captures a lot of money. So I don't know what's going to happen. I kind of doubt it. They'll probably trim it down a bit. But if they did make that big change, it's going to help all the people who didn't vote for him. Pretty funny. Now, one other thing about you mentioned about examples, Brad, of other expenses that you could deduct. Certain things like if you spend a lot of money on your new house, on home improvements, generally speaking, like putting in a new bathroom or a kitchen, you cannot deduct that. So what you can deduct, generally, the big ticket items here are mortgage interest, not the total amount that you paid, but the interest, not the principal. The points you can deduct usually for a first time, and property taxes, things like that.
And then while we're on the subject, the other side of the coin, what are some things that homeowners cannot deduct? I think there's so many things that people missed out there that think they can or cannot deduct. Straight from you, what are some things they cannot deduct? And while you're saying that, I'm going to lower the camera a little bit too. We're fine, but
sure. So the things you can't deduct would be things that are not mortgage interest, not points, not property taxes. There would be things like your home insurance, your fire insurance, your homeowners association dues, things like that, or condo association fees. You can't deduct those. There's a however, which is if you are claiming part of your home, your new property, as a business for home office, let's say, then to the extent, and that would be a percentage based typically on a per square footage percentage. So let's say out of a whole house, this room was the office, and you do a map or a diagram of the whole property, and this is 29.3335%. Then you would deduct that percent of your otherwise also normally deductible things like mortgage interest, property taxes, but also 29 point blah 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 percent of your homeowners association, your gardener, your utilities, all of those things. You could deduct things that otherwise you could not deduct. However, when you do claim the home office, you have to be careful how you do it.
yeah,
Okay, most people don't really do it right. I always encourage that there's a diagram. Don't hire an architect, but do a diagram, and then you're only supposed to deduct the exclusive space that you use as a home office. Okay, it's only that.
so if my office is also my daughter's playroom,
Bad. Yeah,
I gotta kick her out then. She has to go.
you got to kick her out. You actually have to have iron bars to keep her out. Actually,
I mean that's part of my plan. Yeah.
Well, there is a case I know of where the taxpayer was being audited in their home office. Otherwise, it was a home office, like you're referring.
Yeah.
And the daughter or the kid walks in pulling a duck waddle toy, those little things. And the IRS officer was there, and the IRS officer said, well, everything looks okay, fine. And he sees the kid coming in, pulling a waddle duck toy and playing on the floor in the exclusive home office. The IRS auditor looks at the baby and says, deduction denied. The entire home office was denied because it was not exclusive. It has to be exclusive home office space.
Okay, there we go. Well, I'm gonna get back home and tell my wife that there's some new rules in the house here that
they're long-standing rules, but
yes.
No playing in the office.
Good. And then moving on a little bit to other things that owners should be thinking about that can change their taxes circumstantially, for instance. So say you've been in the house for a while and you've been living there. What are some things that people should be thinking about that could affect the taxes going forward?
Oh gosh, I mean, there's a million things that can happen. You could, I could go on for hours talking about this, but some things that would happen would be, well, you get a divorce, so then you have to buy out your spouse. You have to be careful to do that in a way that is not taxable. If you have, let's say, all sorts of crazy things can happen, like if you have a property that you were living in, and then you move out, but you're renting it to a sibling or a family member, and then it generates a lot of losses. But if you're renting it at below market rates, but you're claiming the losses, because you can claim up to $25,000 generally, then Uncle Sam, if they see that you were renting to a related party at below market, they will deny everything. Okay? So you have to be careful in those transitions. There's so many life changes that can happen in the case of death, where it might affect your taxes. Also, if you, let's say, get a property from a loved one who's passed on, there's certain ways that their low Proposition 13 property tax basis, where they might be paying a couple $100s, if you do the wrong thing, if you don't work with an estate attorney, then your property taxes could jump from maybe a couple $100s to $25,000 or $30,000. So one has to be a little careful when you have certain big changes. Yeah. But I think on some of those things, generally somebody like yourself is going to be, aware. You don't necessarily have to always check with an estate attorney, you probably should talk to a CPA, but on many of these common things, you're going to know a lot of the general hot buttons.
Yeah, and I'd say there's so much complexity and so many different circumstances out there that it is worth talking to a CPA, talking to a state attorney, just to make sure that you have all the information correct. Don't do what I do, and if I feel sick or feel ill, just go to mayoclinic.com and self-diagnose, because I'm not a doctor, so don't do it.
Well, sometimes it's fine to take aspirin too.
Yeah, or just go outside and get some fresh air.
That is true. That is true.
Okay, well, great. Those are a couple topics on the homeowner side. I do want to talk a little bit about, you do work also with not just individuals, but owners of businesses. And so for those in the audience who either have their own companies, intend to start their own companies, part of what you do is the strategy and the advisory to how to best set up their business for success. Can you just speak to that a little bit in terms of what they should be thinking about or doing?
Sure. Well, first of all, some people they think, well, my God, I'm starting a business. I have to set up a Delaware corporation, and I have to get real fancy. And if you go to an attorney and you say, hey, what should I do? They're going to say first, oh, you need to incorporate. Absolutely, pay me money to set it up, and then you're going to end up paying a lot of money to a CPA to do the tax returns. Then you might have to take salaries. It gets complicated. So if you're starting a business, the best thing is really to focus on business basics. You could probably operate as a sole proprietorship. You probably have to get a permit from the city of San Francisco, or if you're doing business under another name like Einstein Programming, you could do that, but you just have to go through something called a DBA filing process. You don't necessarily have to incorporate. And then probably one of the more flexible, if you do have other people in the business, or if your business has some sort of risk, you could get something called the corporate veil. That doesn't necessarily mean that you need to create a corporation. You could go to an alternative type of entity called an LLC, which does give you the corporate veil. And that's an LLC. It's very flexible in many regards. But if you've got something you got that patent that's going to be going big real soon, then set up a C Corp. That's kind of the gold standard in terms of venture world for businesses. Set up a C Corp, probably do Delaware. Why? It's just friendlier for foreign and domestic companies that are going to be going big soon. But if you're doing business here, you'll still need to register with the great state of California. That's one thing about basic formation. So try not to get too involved on setting up legal structures if you can help on it. Help. because if you listen to everything that the attorneys say or do everything, you're going to go broke. Okay? And then another thing in terms of for businesses, I like to always recommend that people set up a separate business checking account. So if you actually have a business that's starting out or one that's ongoing, I encourage people to practice what I call safe sex accounting. So what is safe sex accounting? It's basically keeping it separate, keeping it clean. Get a separate business checking account. Get a separate business credit card. It doesn't have to say Albert Einstein programming. It could just say your name. But know that that is the one you use for business. Why?
Yeah.
Because then you're funneling the data into that one bank account. And then also it makes your year-end process of dealing with taxes, or if you ever had to go through your finances with anybody else, it's cleaner, it's easier. They know everything that's in there is just for the business. And then it also just makes your year-end process easier. It's not commingled. So if the IRS ever comes in and they see that stuff is commingled, they generally are going to doubt everything. Okay? So remember, safe sex accounting. Now, the other question is some people think, I heard that Joe in the Christmas party said that they're fully deducting their Porsche or Aston Martin, or I guess being San Francisco, I would say the Tesla,
Yes.
right? Well, just because somebody said it on the cocktail party or the Christmas event doesn't make it so. There's a lot of nitpicky rules here. Some people ask me, well, what can I deduct? And the question is fairly simple, yet not simple. But the simple, big picture thing, and always remember this, is you can deduct any expense that you need to incur in order to be gainfully self-employed or to conduct the business. Okay, that's the big picture rule. Now, for things like food, for cars, for gifts, things like that, there's some special rules. But always remember that big picture. There was a lady who went to jail. Actually, she owned a very large property out near SF State. Leona Helmsley went to jail because she wasn't mindful of this rule. And the famous quote from I think before she got locked up in jail, one of the reasons why she got locked up in jail, she said she was expensing the poodle, her butler, and all these like food, champagne. And she said, "What? Only little people pay taxes. I don't pay taxes." So I always think of her fondly. Now, one other thing. So let's say you do have a home office. You have to know that it does increase your audit risk. So if you approach it foolishly and you say, 100% of my property, that's all business, and I'm living there, and everything is rounded numbers and all that, that does raise what I call the skull and crossbones, the pirate flag up the pirate flag pole. But if you're careful about it and you're using precise numbers, okay, and you do that diagram of the condo, and it's legit, and overall you don't have any other risky issues going on.
No kids pulling the duck toy through the office.
Right.
Yeah.
Then that's right. And then it can result in some unique opportunities. So if you make what I call your world headquarters is your home office, right?
Yes.
And you have no other office, no other place where you are working, okay? Let's say you're an employee. Well, let's forget about it if you're an employee. So if you're an independent contractor and you have no other place to work, if your world headquarters is your home office, this other room, then when you drive from your world headquarters out to see clients or other places, that is all business miles. But if instead, let's say, you lived at home and you've got an office downtown, when you drive from your home to downtown or or the South Bay or something, that is to an office there where you work, that is not deductible miles. Those are commuting personal miles. Okay? So if you can make your home office truly be what I call your world headquarters, you can deduct a lot more in mileage or claim a greater percentage of business use for your Tesla.
Gotcha. Okay, very good. And And let's talk about a little bit about your clientele. In the intro there, we talked about the wide range of clients and people that you serve. A question that I'm curious about is typically when is a good time for client or prospective clients to engage your services? What symptoms are they seeing in their business? What things are they dealing with that should tell them it's time to talk to David?
Sure. Well, we specialize on situations where people have complexity and issues. I do handle what I call, like Stephen Martin always said, wild and crazy tax situations, semi-litigation cases. We do get a lot of referrals from attorneys before litigation, advising them during litigation, post-litigation, like collecting on a settlement, like are the numbers that people are giving, is it legit? Sometimes on the offensive and then sometimes on the defensive side, depends which attorney I'm working with. So we do get a lot of referrals from attorneys, some litigators, estate attorneys, also some venture attorneys. And they do run the gamut in terms of industries. We have some folks in real estate, law firms, plastic surgeons, back surgeons, eye surgeons. But we also have normal folks. So the question is, when should somebody come to see either my firm or a CPA? There is that pretty good product, TurboTax, and there's some others out there. And we encourage people, if you can, do it on your own. That's good. But when you have a business, if you're a little confused about things, it's probably good to come in and see somebody. Generally, it should be a CPA, not Joe Schmuck or the Albert Einstein Institute of Taxation, which is not licensed. We CPAs are, generally speaking, or always, I should say, an ethical lot, but you should go to somebody who's experienced in taxes. And so if you have a business, I would say there's a greater likelihood that you should be going to see somebody because you might be missing something, or you might be doing it wrong, and you don't want to get tripped up.
Yeah.
Now, if you're in the real estate business, there's some unique things you can do, like being deemed or self-declaring yourself as a real estate professional. That can be very powerful, and you can take some giant deductions on rental real estate losses. However, when you do that, then you end up with a giant target on your back. You become an IRS target. So certain things that you do can result in complexity. Another reason when people might come to see us would be where, let's say they owe money to the IRS, they haven't filed in a number of years, or they're being audited, things like that where we can really step in. And I enjoy that sort of work. They're really difficult cases and sometimes forensic cases where they have no data. But hopefully normal people can just do returns on their own. We will see what happens with our future President Trump, what he puts in. There's talk of changing the deductions so that the itemized deduction right now, it's around about $7,000 or so, it's going to double up to whatever it's going to be, 15, 18 grand or something like that. So if you live in Peoria, Illinois, or Iowa or somewhere, or Houston, Texas, where mortgages are low, then that's going to be good because then your mortgage, each individual will get a large deduction without even owning a house. So that, in a way, might be good for them. For us out here on the coasts, we'll still need to be itemizing deductions because some of those changes won't help us. There is talk also of limiting, or they say wiping out the mortgage deduction, or limiting or capping off the deductions for real estate taxes. There's talk of that. I think if they tried to limit the mortgage interest deduction or wipe it out, you'd have a lot of people running around at night with flames and pitchforks marching down on the White House, down on Pennsylvania Avenue. But again, it's quite possible that some of the things they may do will be done to harm us on the coast who didn't vote for them.
Gotcha. And then last topic here. I'm excited for your thoughts and your answer on this one. I'm always curious about kind of what you're seeing and hearing out there in the economy, both in San Francisco, the Bay Area, but also your thoughts, globally. We, here in San Francisco, there's a lot of technology. Obviously, we have a new president coming on board next year. So all that being said, just some thoughts on the economy, if you will.
It is kind of interesting that back in the .com era, I sort of thought things were something was out of whack and coming to an end when I had the mailman come in and I think a muni bus driver come in so excited because they were making a fortune, so they thought, on Yahoo stock. And I thought, my God, the end is near. Now, I was with an estate attorney colleague of mine going in a taxi out to an event, and on the front seat of the car, the taxi driver had a laptop open and he was looking at stock charts. And I thought, oh my God, it might be happening again. Some correction. Now, another indicator of correction, I have a lot of art galleries as clients, and for a number of them, their sales are half what they were last year. So so is that the tip of the spear? Is that an indicator of something coming down? Perhaps. There are some things that, presidents can't control. Arguably, they don't control a lot. We'll see. One thing in terms of, so I think we're going to have cycles, of course, in real estate. Real estate here is overpriced relative to people's salaries. Generally, it just can't keep up. Yet, then again, San Francisco is an island. But the one thing that I see as happening here in the Bay Area is a great confluence of technologies that's going to create a lot of value, namely IT and biotech. And it's really happening in this corridor from San Francisco, the UC campus here south of Market, down to Stanford. There's going to be, I believe, a tremendous explosion. That's all long-term money. While some of those companies kind of boom and bust, but it's a very long-term play. I was COO of a European company here in the U.S. where they did all of the clinical trial software in the pharma space globally. So I've had an exposure into that, a glimpse into that amazing industry, but it's very long-term money. And what we're seeing now is, I think we've only just begun to see the start of it. I think it's going to blow Uber away. It's going to blow Airbnb. That's going to be nothing, I think, in comparison. That's what I see in the long-term horizon is coming down the pike, and I don't think it's even hit yet.
Biotech in particular, you're saying?
It's the convergence of IT and biotech, and I think it's, and pharma. I think it's only just beginning.
Awesome. Well, we are right up against it in terms of time. I do want to thank David Kupferman for joining me and having me at his office today here on the Barbary Coast. Again, for the audience, we're going to drop David's information into the comments in case you have any questions or want to reach out and get some help from him and his team. And as always, we are going to continue to put these live interviews on. Let me know if there's anyone else that you guys want me to be speaking with and getting perspectives on. We do have several guests lined up in early January already. But again, thank you to David for his time and for his expertise. And until next time, we will see you later. Bye.
Bye-bye.